investors are buying calls on TLT at an unprecedented rate. And that's surprising because bonds are often the slowest and most boring parts of someone's portfolio. Many investors have lost a significant amount of money in what's supposed to be the safe haven part of their portfolio. Some view this recent decline in bonds value as a sign that it may be a good time to buy in as rates are high, hoping the Federal Reserve will lower rates down in the next year and offer a somewhat easy return. This idea, however, relies on the Federal Reserve cutting interest rates back to historic lows that we have witnessed over the past 20 years. And with Bill Ackman and other prominent investors expressing their interest, opinions, and other strategies in the face of this turbulent credit market and unprecedented volatility in the Treasury market, I think it's important to grasp where we may be headed moving forward and determine if bonds are a worthwhile investment. So first, let's talk about why did bonds fall in the first place? Over the past few years, we have experienced an extremely turbulent credit market, mainly with a pandemic that incited one of the most dovish responses in central bank history. This was followed by the whiplash caused by more restrictive policies and the higher rates we see at over 5% currently. With the rise of the risk-free rate, or the federal funds rate, at over 5%, the price of bonds has fallen in step. The drop in prices of nearly all bonds, especially short-dated bonds, has put many financial institutions at risk and is the reason for the bank failures of Silicon Valley Bank and others, as they held long-dated bonds at extremely low rates, and when the rates rose, the value fell significantly. And now that we understand why the Federal Reserve raised rates in response to high inflation and other factors, why do rates have to come down at all? And the question everyone is asking, including the Fed, is can the Fed destroy inflation without breaking the credit markets or the economy? And to be honest, nobody knows that. And if they claim to know it, then they're just flat out lying. There are many predictions to be made and possible or probable outcomes to predict, but truly no one knows exactly what's going to happen. Not even the ones who are in charge of making these rate cut decisions. And given that these things are so hard to predict, I think that it could be more constructive to look at the more certain and straightforward things, rather than trying to predict the winds or psychological factors that are affecting the markets and the broader economy. Now, the two factors that I think you should be focusing on here is one, if rates remain elevated, the US Treasury will have to roll over the national debt into higher interest rate debt. And the second being, new federal spending that is not funded by taxes will be funded at a higher rate. Although there are other variables that will be at play, these two statements are extremely important to remember and can help us understand where we may be going in the future. If we take a look at this graph, we will see that the total debt is increasing at the same time that the average interest rate is climbing due to the elevated rates we are experiencing now. We could see a negative feedback loop where the interest expense keeps ballooning to a point where there is no way to come back from it outside of debasement or inflation, increased taxes, and that's pretty unlikely to happen or even work well if it does, or hoping the economy experiences a large productivity boost and the tax receipts follow. With the 10-year yield reaching nearly 5%, we could see the average interest rate on our total debt reach above that 3% mark. This combined with the continual spending that's funded at greater than 4 or 5% yields by the federal government will continue to increase the deficit as interest payments rack up. This is extremely important to keep in mind, not only as an investor, but as a voter. Because if our average interest rate is somewhere around 2% and we're reaching that all the way up to 3, possibly 3.5%, that's hundreds of billions of dollars added to the deficit that you as a taxpayer will have to pay. And now that we have a clear picture of what it looks like to keep rates higher for longer, I think it becomes clear that this scenario is extremely unlikely. And I think we will see significant reductions in the federal funds rate in the year 2024. But what I'm not sure of is where the federal funds rate will land. I would be extremely surprised to see the federal funds rate come back down to COVID lows, but if I had to take a guess, I would say that it lands somewhere between 2 and 3.5% in the next couple of years. And let me re-emphasize that no one actually knows, including myself, where this federal funds rate will land. So it's important to recognize that when you're considering investments like TLT, because of how uncertain the future is. Over the past 40 years, we've seen a massive bull run in bonds, but I think we're entering a new era of a higher terminal rate, somewhere greater than 1.5%. And I don't think investors should expect the federal funds rate to return back to COVID lows, where the cost of capital was near zero. And the reason, like I stated above, is because of the tough situation that the US government is in. And they still need to find demand for this new debt. And if they don't, then yields will just continue to rise. Now, I want to make it clear that I'm not saying that we're anywhere near a debt spiral, because compared to the rest of the world, the US is still in a dominant position in terms of the demand for the US dollar. That being said, we cannot ignore the trend of unlimited spending that balloons deficits and makes our debt surpass 120% debt to GDP. Many people may see this number and think that this is completely unsustainable, and often push the narrative that we are in a death spiral. However, I think those that are peddling this narrative are viewing our numbers and metrics in isolation from the rest of the world, rather than viewing the US's position in relative terms, comparing them to other countries throughout the world. With the assumption that the US can sustain this level of debt for decades to come, given its dominant position in international trade and the strain other countries are already in, I think it's unrealistic to be calling for the demise of the US credit markets anytime soon. Rates will most likely come back down to higher lows to maintain stability throughout the economy, but also without restricting credit markets too much, which could offer a somewhat decent return over that time period. However, the key part in deciphering what you're going to get as a return if bond yields continue to come down is how far will they end up going. Because if they fall down to COVID lows, you could make out like a bandit over the next couple of years. But with that being a somewhat unlikely scenario, I think you're more likely to see a somewhat moderate return on your money if you invested in something like TLT. Another really important thing to consider is what happens to all other types of assets if rates start to fall. And if we assume that rates have to fall over the next couple of years because of the tough spot that the US federal government is in terms of making payments on their debt, it's important to take a look at the stocks and Bitcoin potentially, as well as gold and other commodities, and what will happen with all of those to assess if this is really the best place to be in that environment. If the Federal Reserve lowers rates, companies that rely on financing like Tesla or real estate investment trusts could benefit the most as the cost of borrowing decreases. We could also expect the broader stock market to rise as there would be massive inflows out of bonds and into stocks, because certain investors couldn't resist the 5% yield on a long-dated bond. But as that starts to fall back down to 4, 3, 2%, there will be new cohorts of investors that are flowing out from bonds and into stocks as these rates continue to fall, driving multiples and stocks higher. So if you're considering this investment, I think you need to ask yourself this one question. If the cost of many companies' debt is decreasing while money is flowing out of bonds and into stocks, what could we expect in terms of a return compared to the bond market? In my opinion, I do not plan on investing in the credit market, as I believe that although we are far from a default, the road that the government and the Fed is on is a dangerous, volatile path with many unpredictable variables that could change at any moment. This leads me to believe that I would rather invest my hard-earned capital in companies that are creating value and grow into the future, rather than fixed income assets that are part of a complicated game of balancing inflation and demand destruction. Thanks for watching, guys. This isn't financial advice. Now, don't go out and buy some bond or stock just because of this. Do your own research and see what you think about what the Federal Reserve is primed to do throughout these next couple of years. And if you like this video, feel free to subscribe. I'll see you in the next one.